So just by way of introduction, I'm Guy Kaufman. I hope that's obvious from the name on the screen. I head up the startups and growth team at Vested. So we help with everything from cap table management to share schemes and fundraising. I'm going to focus in the sort of, I suppose, like technical preparation for a funding round today, as opposed to, I know lots of what you've done in the past would be pitch decks and marketing the opportunity and that sort of stuff. Hopefully it's not going to be too dry, and hopefully you'll all get something out of it. Please do ask questions. First thing I want to talk about is getting your cap table ready. So cap table, what is a cap table? This effectively details the ownership of your company. So every limited company in the UK is split into shares. Holders of these shares have certain rights, and they're laid out in the company's articles of association. Ahead of a funding round, we would always take founders through a sort of cap table health check, cap table audit, and try and prep it. There's lots of things that you can do to get your cap table ready. I'm conscious that we've only got half an hour, so I'm just going to focus in on some of the main points. And if you could take anything away from this discussion, I guess it would be the principle that once your business holds value, so once you've raised investment, or indeed if you are a company that is generating really quite material revenues, you know, maybe 100 grand, and you start issuing shares to people, or indeed you start transferring shares, what you'll find is you create a tax liability for the recipient, an income tax liability on the value of whatever you're giving to them. Reason being, it's treated by HMRC as a payment in kind. In effect, what you're doing is saying, Guy, you're a fab consultant. You've been really, really useful. We think you'd be a great person to have, you know, working within the business. And instead of cash, we're going to pay you in shares. Consequently, if you wait to set people up on your cap table, be they co-founders, employees, or advisors, what you're going to end up doing is creating a tax liability for them. So I don't know how many people in this room have already raised, or whether most of you are raising for the first time. But either way, there is a lot of value to setting up your cap table, issuing co-founders, issuing employees, issuing advisors with their shares, or indeed share options or other equity incentives ahead of a funding round, as opposed to afterwards. If it's your first funding round, you're going to be crystallizing some value in what was potentially, up until this point, from a tax perspective, a zero value business. And if it is a second or third round, what you're likely to be doing is raising at a higher valuation, and so crystallizing this higher value. And yet again, you know, if you were to issue shares to people, you will create a larger tax liability for them. There are certain ways that you can kind of, I don't want to say get around it, but mitigate for that using structures such as growth shares, which I haven't planned to go into in this presentation. But I think as a general rule, what everybody should be looking to do is to set up any of those people on their cap table ahead of a funding round. The second point that I would make would be that if you are issuing shares to people, if you are setting up a co-founder, an early employee, an advisor, whoever it might be, with sweat equity, i.e. they're not paying for those shares in cash, rather they're paying for it in the services that they're, you know, rendering for the company, there should always, and I mean always, be strings attached. And certainly investors, certainly, you know, more professional investors and institutional investors will want to know that there is no dead equity on your cap table. They will want to know that everybody who has a stake in this business is actively contributing towards its success, is actively growing that business. Again, there's lots of different ways that you can do this. Assuming that you're talking about a co-founder, the most obvious way to do it would be to set up a founders agreement. Relatively simple agreement. It's effectively a form of shareholders agreement, but special and specific to the co-founder role. So it will establish what your role in the business is, and it will usually also establish some sort of vesting schedule. Within a co-founders agreement, certainly, it's likely to be a simple time-based vesting schedule, meaning that over time, you and your co-founder will earn more of those shares. You'll bank them, if you like. And should people fail to deliver, maybe they leave the business. And I should say people leave the business for all sorts of reasons, good as well as bad. You know, this isn't always a case of knives in the back and betrayal. Sometimes people's circumstances change and they can't contribute to the business anymore, but they should no longer be earning that stake in it. Then there are various mechanisms that exist that allow you to redistribute those shares. When you're looking at founders agreements, it is important to be somewhat aware of the mechanics that support that vesting. I'm about to get into something that sounds a little bit dry, I appreciate, but I'm just going to flag it because I've seen these mistakes in the past and it can be quite costly. So when using vested, and we provide simple founders agreements on our basic subscriptions, we use a process of deferral and cancellation. Outside of vested, I'll frequently see two other mechanisms that work but can be problematic. So the first of those is that it relies upon a transfer of shares between co-founders. So Gaurav and Deborah, you're the two people I can see on my screen, so I'm going to use you as my examples. Gaurav has left the business early because his personal circumstances have changed and he's been, offered a new CTO job at Anthropic. Who could turn it down? In this circumstance, according to his founders agreement, he now has to transfer his shares to Deborah. But they've done 2 funding rounds already. And the business is now valued at £10 million. Deborah would be the recipient of shares worth, £4 million, let's say. And consequently would have to pay a tax bill on £4 million worth of shares. Deborah, I don't know your circumstance, but there's not that many people I know who have, a couple million quid sat in the bank and can pay that sort of income tax bill, off the bat. So that's the kind of problem that you can run into if you're not careful about exactly how these are structured. You'll often also see buybacks from the company. The company will buy back these shares and cancel them. That can work, but there's actually really strict rules that govern how buybacks work in the UK. It's a bit more complicated and nuanced than this, but generally speaking, they can only be bought back if the business has sufficient retained profits to buy back those shares. And that can work, but oftentimes companies are reinvesting all of the profits they make into their growth. And so again, you're in this scenario whereby, okay, you've created a founders agreement and you thought you've legislated for it, but actually in the moment, you're not legally able to buy back those shares and cancel them. And so you've just created a kind of mess for yourselves. So what I'm saying is have a founders agreement, make sure it's a properly drafted one. There's a lot of crap out there, templates online that basically don't work in the situations that most founders find themselves in. So set people up on your cap table, but make sure that if you're setting people up on your cap table, they have vesting conditions attached to those shares such that you can hold them to account and such that everybody knows actually what they're supposed to do. It is a sensible discussion to have. Final point about setting people up on your cap table ahead of a funding round, before I really need to move on because I'm trying to cover a lot, is that investors would rather people be set up ahead of investing Because if you issue these shares immediately after the investors have invested, they will be diluted. So they would much rather see that you have actually thought this through and you have created incentive structures for those key team members, or indeed for your co-founders, to stay on before they invest. Otherwise, they're going to, bear the brunt of it. That's really the main points I wanted to talk about cap tables. I know there's a bunch of other stuff on my slides, but before I do that, before I move on, can I just check whether anybody has any questions?
Guy, I might have a dumb question,
No dumb
yeah,
questions.
but you look at this and you go, if there's no money changing hands, then why is there any tax or anything until the sale of the company?
Yeah, completely. And I think that's what a lot of people assume, Gary. So it's not dumb at all. Most people would think, well, I haven't received any cash. Why do I owe tax? The best way I can describe it is in previous jobs where I've had like gym membership come as part of my remuneration package. And I've always been surprised to see I then paid tax on half of that gym membership that I never used. It's just seen by HMRC as part of your payment, and it does often get people. You'll see people quite commonly in this scenario where maybe a co-founder leaves and a new co-founder is joining, and you think, gosh, how do I set them up? Now, there are ways to do it. I don't want it to sound like this is completely prohibitive and you're stuck. Very often we'll use this growth share structure to get people onto the cap table at a later date, such that they own shares without having to pay an income tax bill. But the principle is these shares hold value. If you're transferring them, if you're issuing them, that value will be taxed.
Right.
Yeah,
If they get charged tax when you're giving them the shares at day one,
yeah,
if you sell the business,
yeah.
right, do they get taxed again?
Yeah. So I'll do a kind of worked example. My girlfriend's moved my calculator, so I'll have to use quite simple numbers. But let's say I receive a share worth £1. I told you simple numbers. Um, on receipt of that share worth £1, I'm going to pay income tax on it, marginal rate. Let's say 40% higher rate tax earner. I'm paying 40p away in tax. We then sell the business at £10 a share. I'll pay capital gains tax on that £9 delta between £1 and £10, 24%. 24% of £9 is something I actually can't do in my head, but is a number. So yes, you'll pay capital gains on exit, but you'll pay income tax on the value of what you receive at that point. And actually, this concept is a lot of the reason that vested exists, or businesses like vested exist. It's that you can mitigate that impact when you set up structures like EMI options that are extremely tax advantaged, or indeed like growth shares, which I've mentioned a couple of times now, which are in effect a special class of shares that have limited rights to capital, such that they only participate in future value. They are probably a presentation in and of themselves, so I'm not going to get into all of the specifics unless there are lots of questions on exactly how they work. But yes, you'll pay income tax on the value of what you receive, and then you'll pay capital gains tax on any growth to the point of exit.
Guy, I had a couple of questions very quickly. So first and
Please.
foremost, are the class of shares for both parties the same? So for the investor and the person who's already within the business is a class A, in terms of the cap?
I mean, it depends. Really unhelpful answer from me. Most typically on pre-seed and seed rounds in the UK, you'll be raising via the SEIS or EIS scheme, which I've got a few slides on coming up. those schemes don't allow for preference shares. And so most commonly you see people issuing just ordinary shares to investors. Outside of that, and certainly when you start working with institutional investors, it's pretty common that they're requiring some sort of preferential rights, usually, liquidity preferences or something like that.
Yeah.
In which case, it's likely going to be a different class of shares.
Okay. And my final question, and it's super quick, but we can always take it offline. I'm an advisor to multiple boards. So when they bring me in, they try and offer me a couple of percentage equity of the company so they can reduce the day rate, right? Is that then something that I should be aware of from a tax liability perspective as well, right? When they're
absolutely. So, as you can imagine, we do lots of work helping businesses incentivize advisors in exactly that way and for exactly that reason. And most commonly, the structures that they'll use to mitigate that would either be to set up an unapproved option scheme. That's probably the most common route, to be honest with you. So, this is effectively a contract to buy shares at some point in the future. You set the price that they're paying for their shares today. So let's say it's £1. And once they've done X, Y, and Z, they're able to exercise their option and buy the shares. However, even with an unapproved option, at the point that you exercise your option and buy the shares, you pay an income tax bill, and it's on the value of the option. So if the exercise price was £1 and the market value at the point that you exercise was £5, you pay income tax on that £4 delta.
Wow. Okay. So I have to be careful if a next $100 million company decides to give me 10%.
Right.
Okay. Yeah.
But,
Cool.
but what we see a lot, and we will take this offline, but it might be interesting for other people in this room. So I'll try and explain it both as briefly and as clearly as I can. One of the tools that we use a lot at Vested are growth shares, not option agreements, special class of shares. Become more and more common. When I started out, really, they were just the preserve of sort of private equity, because lawyers would charge you an arm and a leg to set them up. But in effect, the way that they work is you create this special class of shares. So we enable them within our standard articles of association. And this class of shares only participates in the future growth of the company. So we do a valuation of the business, and we might say the company is worth £1 per share. I would usually have slides on this, but you're going to have to deal with my kind of, YMCA moves instead. But the business today is worth £1. We then apply a premium to that. It's usually 20%, but it technically just needs to be higher than current value. So you set a hurdle rate at, for example, the £1.20 level. Now, these growth shares would only participate in the future above the £1.20 level. So when the business exits at £10, they only participate in £8.80 worth of value. But what it means is when they're issued, they're effectively out of the money. And so they don't hold value. And income tax is applied when the shares are issued. When they're issued, they don't hold value. So there's no income tax. And instead, they'll only attract capital gains. They'll attract capital gains at the point of sale, clearly, and it will just be on that £8.80 worth of value. But what it means is, rather than paying income tax at the outset when the business might fail, or indeed in the case of options, paying income tax on all of the growth between the exercise price and the point of exercise, you're just paying capital gains. So oftentimes that's a difference of paying 24% capital gains tax compared to 45% income tax. So substantial difference in terms of what you're leaving on the table or what you're taking away if the business is successful. Really, growth shares warrant an entire presentation, and I've just condensed it into a 30-second charades episode. So apologies for that. But if anybody has more questions on it, feel free to ping me a message. or indeed I can send over some content to Ollie and Gary and the team and share that with you that way.
Well, what I was going to say, Guy, this has stimulated more questions, and I think we need to get you back to do some more of this. I think it's really, really important. As everyone knows in the room, we're currently being sponsored by Vested, and they're going to be speaking at our event next month. And Vested have been very good in sorting out a discount code for Startup to Stand Up members. I've just put it in the chat. So if you want to take advantage of that, if you want to speak to Guy, you can reach out to Guy via LinkedIn or come through me. Just drop me a message or an email and ask for an introduction, and I'll send you over to Guy and his team at Vested. But who's there? You got a call?
Yeah, just had a quick question. Actually, it was again based on the cap table, etc. So we've got consumer products good. We're launching in September, October. We've got someone who's a business mentor advisor who wants to invest pre-seed, pre-revenue, and the way they were wanting to structure it is have half the shares non-diluting and half the shares ordinary. And as far as I can see, looking online and getting advice, is non-diluting shares a kind of a big no-no in the future if you want to raise later on, or would you say stick to ordinary? Yeah,
that would be my view. Like, difficult to say without being involved in the actual commercials of it all, but it's very unusual to have non-dilutive shares at that earlier stage, and it's usually a red flag if you are going on to pursue certainly institutional money, whether that's VC or other forms of professional investors, not least because you won't have non-dilutive shares and they won't have non-dilutive shares. So each future round that happens, you're going to be reducing your stake in the business and they're going to be staying at their 5% or whatever it is. Although I'm always apprehensive about weighing in too strongly on one side in these questions, I would just say it's very unusual, and so be aware of that.
Cool. Makes sense. Cheers.
Cool.
Guy, what else do you do?
What else do we do at Vested? Or so we're what our marketing team call a share tech platform. I've told so many people in the pub that I work in share tech, and I don't think I've ever had a look of recognition from a single person. It's equity management, complete equity management. So obviously we've been talking about cap tables today. I personally do lots of work on fundraising. So I'll go through some of these other slides, although I'm aware that we may be running out of time. And that might mean getting people SEIS and EIS advanced assurance. It might be generating investment agreements for them, issuing shares, all of that sort of stuff. Really, our bread and butter, what we're probably best known for, is share scheme structures. So the sorts of things I was just talking to Gaurav about in terms of setting up tax efficient, properly conditionally structured equity incentives for people. Now, lots of people, or some people, may be aware of EMI option schemes. I think we probably do set up more EMI option schemes than anyone in the country, but there's a kind of entire universe of different equity incentives out there. And what we try to do is sit down with our clients, with our customers, and understand exactly what they're trying to achieve. So who actually are you incentivizing? Is it an advisor like Gaurav? In which case, we might look at unapproved options. We might look at EMI growth shares, or are they an employee? Is this going to be an EMI scheme? Is it going to be a CSOP? We can set up phantom shares. So there's a lot out there, and the idea is, we're a tech business, we're a SaaS company, but we're very much a SaaS company with a human face. We are a guided SaaS, which I think is a made-up term, but we are a guided SaaS, meaning, the tech will do a lot of the heavy lifting, but ultimately we want to ensure people are getting it right first time and have the comfort of being able to talk it through with a with a consultant and understand exactly what they're doing. I'm aware that we're probably at 10 and I haven't got past slide 1. I guess I was going to ask how much time people have.
All the best talks always exceed the time limit. Don't worry about it. I've got a question from you. I've done EMI share options in the past.
Yeah.
I've been told by advisor after advisor that they're very complex and you should get someone who is almost specialist in putting these things together. Do you do that in-house, Guy, or is that work that's farmed out to a specialist?
Yeah, everything we do is in-house. So, to set up an EMI scheme, to give you some context, it's a pretty straightforward process, in my opinion. You need to create a share pool. So our platform would generate directors and shareholders resolutions to authorize that option pool. You then need to do a valuation of the business so that you're able to price the option in the most tax efficient way possible. Generally, you would price an EMI option at market value at the point that you're granting it. We have a large and significantly and really experienced team of valuation analysts who would do that valuation for you so that it's submitted to HMRC and approved as quickly as possible. And we would then create the scheme itself, i.e. the vesting conditions people need to adhere to in order to earn their stake in the company. And our platform, again, will allow you to really create any conditions that you can conceive of, so long as they're enforceable, by which I mean they are tangible and binary rules, as opposed to a kind of, hey, if I think you're doing well in 5 years, you can get these. My advice to people, though, is kind of keep it simple, stupid, because sometimes you're right, Ollie, people do try and get like dastardly complicated with the rules, and you get these intricate formula about just how many shares people are going to get depending on different outcomes. Like, we can facilitate that, but as with all things, if it's simpler, the people who you're trying to incentivize and motivate will likely get it and understand what they have to do, and so actually aim towards that goal. If they don't get it, it just gets filed away and never looked at again. But yes,
I've seen so many. I concur. I've seen so many examples where founder team they try to be too sophisticated at the very start, and then they encounter problems down the road where it may deter certain investors.
Yeah,
and that was the aim initially, to impress investors with how the level of sophistication they use.
I think it depends on the stage that the business is at as well. So, I think most people here are a relatively early stage. If that's the case, it's very difficult to set KPIs for the long term that people are realistically going to be able to adhere to. You set a revenue target today, 50 grand might be smashing it out of the park. 2 years' time, that same 50 grand target might be a massive underperformance. And so it can be quite difficult to do that at this stage. Whereas a time-based vesting schedule, if I'm still here in 4 years, I assume you like what I'm doing because you haven't fired me yet, or I haven't gone, and that's it. You're trying to incentivize someone to come on this journey with you. So, you can be complicated, but as with most things in life, simplicity usually trumps complexity.
Absolutely.
Guy,
any further questions?
Sorry,
Andre.
Could I just ask a very quick question? For argument's sake, if all of those elements are in place, your cap tables are in place, and all your everything's sort of ready to go, what's the next stages then? Do you help with getting the investment, or do you just help in getting us set up ready for the investment?
We're the setup and execution. We don't do investor matching per se. you know, we've looked at it, and it's a bit of a
minefield.
Yeah, that's it. I mean, we are actually regulated, and we're regulated to do that kind of activity. However, it's a minefield, and what you often find is you're promising two things to two parties that are a bit incompatible. So you know, you can't tell every startup that you're going to put them in front of an investor, and you can't tell every investor and equally tell all these investors that you're only going to put the best startups in front of them without disappointing someone. So we haven't done that. We are partnered with you know, various organizations that do specialize in it, from companies that kind of assist with outreach to investors, to angel networks and so forth. But what we really do would be, you know, in the context of our investment package, it would be help you set up your cap table, from sorting a subdivision to an option pool to founders agreement. Get SEIS and EIS advanced assurance. I haven't got into that. I mean, it was in one of my other slides, but get SEIS and EIS advanced assurance. Are most of you aware of what the SEIS and EIS schemes are?
I'm actually EIS assured.
Okay, fab. So, like, always something that I'd suggest to people, whether they're doing it with vested or, you know, you go direct to HMRC, this is a fantastic scheme. It is pretty phenomenal tax relief available to investors, not just the headline figures, which is income tax relief, but there's also stuff like reinvestment relief. So, you know, if I sold a property,
I'm hoping it's gonna be preserved.
Yeah,
with this current government. I'm fingers crossed. It is so good. It's so beneficial.
I think it will. They just extended the amount of relief available in the EIS scheme. So it used to be you could get tax relief on up to 12 million. It's now up to 24 million. So I think, you know, there is recognition from the government that actually this is one of the schemes that keeps the startup scene in the UK vibrant and encourages people to put money into what is a risky investment, right? All startups are high risk. But going through the SEIS and EIS process, we can build data rooms on the platform so that you can you know, allow your investors to do their due diligence properly and see exactly who's seeing what. And then it's investment agreement generation. We've got a full suite, from term sheets to safes to ASAs to subscription agreements, shareholders agreements. Will help you put the whole thing together, issue the shares, share certificates, and on the EIS, Andre, you know, you start with the advanced assurance, and then you have to do the compliance on the other side, and that's actually easier but more time consuming often, and that's what they'll need to claim their tax relief on the other side. So yeah, very long-winded answer to your question. Apologies, but it's prep and execution. It's not investing in matching.
Any final questions for Guy this morning? I think, have you got any questions you'd like to raise? No, you're cool. Well, that's been fantastic, Guy. We are very much looking for episode 2 to all of this, which is booked in a few weeks, and also you're going to be talking at the event in July, which will be
thanks.
Wonderful.
Thanks for having me. What I'll do is I'll send you over my slides, because there's some other I think good stuff or interesting stuff in it. Everyone else might think it's dull as ditch water, but I'll send it over to you. Feel free to share it with people. And look, if anyone has questions or they think I can help with something, it doesn't mean you need to sign up to our platform or anything. Feel free to give me a shout, and I'm always happy to have a chat.
Guy, that's been wonderful.
Guy.
You're going to get a lot of love and big ups and the rest of it on LinkedIn and maybe various other social media platforms.
Well, look, thank you so much for having me.
Get ready for the love. Yeah.
Cheers, guys. Take care.
Thank you very much. Cheers, Guy.
Thanks, Guy. Thank you.
Cheers, Ollie.